Hey everyone, my name is Jason Coward, Agency Manager with Texas Farm Bureau Insurance in Lamar and Red River counties. Of course, there are multiple ways to conduct a member 360 review. This is the most common process that I do, and it's proven to be very successful for me. I typically hand out different documents and things throughout the review process. We have uploaded those documents, or a variety of the documents, to this particular program for training purposes. So I hope that you find it beneficial and then it can help you in your review process. Hello, Mr. Jones. My name is Jason Coward. Thank you for coming in today. What we're going to do is review your entire insurance portfolio that you have with us. So we're not only going to talk about the policies that you have in force currently with our company, we're actually going to cover a variety of different topics in different areas. Some areas may apply to you now, some may not. Hopefully our relationship will continue to grow, and as we continue to review your policies and portfolio on a regular basis, then I can make proper recommendations and things at that point. So as you know, Farm Bureau does have an annual membership that the customer is required to pay in order to participate in the insurance services. There's actually two different parts of Farm Bureau. Texas Farm Bureau, the nonprofit agricultural organization, primary purpose is to actually lobby for agriculture. Each county has a nonprofit board of directors. A portion of your dues that you pay each year stay here locally within the county. Our board of directors then budget the income that's received from that, and then their job is to basically spend that money locally to promote agriculture within our local area. We do a lot of different programs and benefits that support agriculture. Probably one of the largest impacts that we have is we're big advocates of FFA, all the ag shows, young farmers and ranchers, and things of that nature. We budget quite a bit of funds that go towards purchasing animals and supporting these young kids that are learning a lot about life as well as agriculture while raising their animals and preparing them for the stock shows or for the livestock shows and so forth. The local county also does a lot of scholarships. They give out multiple scholarships each year to local high school students. There's like a point system. They send out evaluations and applications, and then the board members read through them all and they make the best decision. The board of directors selects X amount of students per year based off the money that we have budgeted. On a state level, we have youth leadership conferences each year. The local students and throughout the state can attend. They typically go to Tarleton University and attend a camp. But on a larger scale, and the primary purpose of Farm Bureau is our lobbying effort. So we have a lobbyist group down at the state level, and basically our politicians, they need people to support them and so forth. We have a policy book that basically states everything that Farm Bureau believes in, which is all about protecting the future of agriculture, trying to reduce the amount of government regulations and so forth. So we can self-sustain, here in America and especially here in Texas. So basically, if these politicians want our fundings and our monies and so forth, then we need them to back our bills and the things that we believe in. There is a big group of voters that are backing this organization. So membership is very, very important to Texas Farm Bureau. Well, back in the early days of Texas Farm Bureau, insurance was not widely offered throughout the county and so forth. It was kind of primarily in your metropolitan areas, your city areas, and it was challenging for farmers and ranchers to get insurance on their equipment and things of that nature. So they saw a market, they saw a niche, and created Texas Farm Bureau Insurance, but made a requirement in order to utilize the insurance company. You had to be a member of Texas Farm Bureau, the nonprofit. So it's actually the utilization of the insurance company is a benefit, a member benefit of Texas Farm Bureau. Now, today in modern times, there's a variety of other benefits. So I would encourage you to go to our website at txfb.org. You can click on member benefits. I can also provide you with some brochures, and there are several discounts and benefits that are out there as far as that's offered to our Farm Bureau members. One, obviously, is the insurance company. You have to be a member to utilize our insurance company. Farm Bureau has a bank. Really great products, especially for rolling stock and vehicles and things of that nature. There's several different discounts for travel and lodging. So if you like to travel, there's hotel discounts and different theme parks. We have different agreements with college sports, discount car seat programs, hearing aid programs, prescription programs. I mean, there's just so many things out there. I believe you can get up to like $500 to $1,000 off of a new Ford pickup. Those programs change each year. But anyway, the point being is if you just use one of your benefits each year, it's going to more than pay for that membership. Another great benefit with that membership that you're paying is you have an accidental death benefit for your family. So for each member and spouse, it starts out at $1,000. And for each dependent child under your membership, it starts out at $500. And then each year you pay your membership dues on time, that death benefit will increase $100 per year up to a maximum of $2,500 per member spouse and $2,000 per child. So it's a really great benefit. Each county sets their own dues. Currently in Lamar County, they're $38. per year. So you get quite a bit with the small membership. So the first thing we want to do is go over your membership record, and I want to make sure that I have all household members included. So make sure we have the husband, we have the wife. You could tell me all the names of your children, get birth dates, occupation, and so forth. And if you don't mind, could I get your wedding anniversary? So we don't do anything with this information outside of the office, but occasionally I may want to send you a happy anniversary card, things of that nature. I want to verify your address, make sure your address is correct. Okay, and do you have a business address as well? Okay, any questions on the membership, any of the benefits, anything that I just covered? Okay, great. So we'll continue on. The next section of the review is going to be to your auto policy. So this is your current declarations page on your auto policy. So this at the top, and this kind of help you be able to read your policy moving forward as you get it in the mail. It's going to start out with the policy effective date. As you can see my mouse moving here, April 27th of 22, expiration 10/27 of 22. So our auto policies are 6-month policies. Some companies offer a 12-month, but Farm Bureau just happens to offer 6 months. So our policies are 6 months. Your rates are locked in for that 6-month period as long as you don't make any changes, and so forth. So we're going to scroll down, make sure that we have all the drivers listed on the policy. So we've got driver 1, we've got driver 2, husband and wife. Are there any other licensed operators in the household? Do you have any dependent children? Do you have any family members that live with you, nieces, nephews, anything like that? It's just very important that we know of every licensed operator in the household. And the primary reason for that is so I can make sure that your policy is designed correctly and everybody's covered in the correct way. Your policy is not all inclusive, just anybody drives it. So I need to make sure that if they're eligible to be on your policy, they're scheduled. If they're not, I need to make sure that they're set up on their own policy or that I'm following proper underwriting guidelines. Okay, next we'll come and we'll review the vehicles you have on your policy. So I'll show you have a 2017 Nissan Titan and then a 2021 Ford Expedition. Are those correct? Are those your two vehicles? Okay. Are there any other vehicles that you believe you have insured that are not currently listed? Okay, great. So there's a few different parts of your auto policy. So one common misconception that I hear quite often is, oh, I have full coverage, which is not actually a real term. So basically when you hear somebody say I have full coverage, pretty much what that's alluding to is you have coverage for physical damage for your vehicle, but there's actually multiple different parts of your policy, and it's very important that you understand what that means. The definition of insurance is the transfer of risk and consideration for the premium paid. And you're basically stating if anything happens over this amount, then you are assuming that risk, and that would be your personal obligation to take care of those accidents or any charges that you could be owed. So the first part of your policy is going to be on bodily injury and property damage. So this is the liability part of your policy and is what is legally required. So if I were to tell you that your coverages are 50, 150, would you know what that means? Yeah, so most people don't, and that's kind of the purpose of getting you in for this review. So let me just give you an example of that. So I have 5 children. Hopefully that's the last one, but I have 5 children. So if we were all in our Suburban going down the road and, God forbid you spilled coffee in your lap and you happen to lose focus and run a stop sign, and you hit my family, and we were injured. So your policy would provide up to $50,000 per each person. No more than $50,000 for me, no more than $50,000 for my wife, so forth and so on. However, it will cap at $100,000 for everybody in the vehicle. So let's say my wife and I are in the front seat. It's a head-on collision, and man, we're messed up pretty bad, and we have to go to the hospital, ambulance and/or care flight. Then you do it takes place in the hospital, an emergency room. You're doing X-rays, CT scans. I have to have surgery, any type of physical therapy or whatnot. Basically, your insurance is only going to provide up to $50,000 for me. Even if I have $100,000, which is your policy limit, it's going to stop at $50,000 because that's the maximum that your policy will pay per one person. But let's say that my wife and I both sustained exactly $50,000 apiece. Well, now your policy's capped out. So for my 5 children in the back, if they're hurt, somebody's got to pay for that. And it's not my fault that she ran the stop sign, even though it may have been an accident, because even good, honest people have accidents. Then you're still liable. And what's going to happen is I'm going to have to sue you to be able to pay for those damages. I mean, especially if I have to come out of pocket. So you need to really understand what your policy limits do for you. So you have a maximum of $50,000 per person and $100,000 per accident. If I were to be driving down the road and I happen to hit you and your family, and man, I hate to even do this, but what if I were that accident, if I were to kill your child, if I were to kill your daughter in the back seat due to my negligence or my accident, I'm pretty sure you're going to sue me. I mean, you're going to. The question is how much are you going to sue me for? I mean, what's the value of your daughter's life? What's what's the value of your wife's life? I mean, if you're like me, I'm the one who provides for my family. I'm the primary source of income. So if something happens to me, then my family's standard of living is way in jeopardy. So it's like, I would assume my wife is going to sue you as well. And it's like, man, what are they going to sue you for? I mean, is that replacing my income? She's still got to raise these children forever. I mean, anyway, it's just a lot to think about. We can what if it all day long, but the primary thing that I want to accomplish is just make sure you understand how your policy works and what limits you are purchasing. Okay. The next part to that is the property damage. So your policy is currently capped at up to $50,000 in property damage. $50,000, I would normally tell you, would cover quite a bit of the vehicles on the road. So at a minimum, I would say do not take less than that. But at the same token, at least in 2022, we're currently in a pretty inflated market. So the results of COVID and shortages and so forth. So with that being said, the vehicle market is through the roof. A year ago, vehicles that were worth 20,000 are now worth almost 40. New vehicles that were 70,000 are now almost 100,000. So, or if not more. So with that being said, your insurance is only going to pay up to $50,000. So anything that's over that, you're going to be personally liable for. So that person that you hit has the right to sue you. They have grounds to do so. And the whole purpose of insurance, or the primary purpose, obviously we want to take care of someone if we hurt them. But outside of that, if you're ever in a lawsuit or in a severe situation, you want your insurance to be able to take care of those claims and not have to use your personal assets, things that you've worked your whole life for and planned for and so forth. And you put people putting liens and judgments on your property and taking money out of savings accounts and brokerage accounts and retirement accounts and real estate and so forth. So it's just very important that you understand how your policy works and how to set your limits adequately. The next part of the policy is personal injury protection. You currently have elected to not take this out. So whenever you started your policy or at some point you removed it, you had to sign an exclusion. The state of Texas requires you to sign an exclusion if you opt out of personal injury protection. And that coverage can be up to $10,000. And the purpose of that is it will provide payments to you, anyone in your vehicle, and provide coverage in and or around your vehicle in the event you're involved in some type of auto accident. It doesn't necessarily have to be a wreck, but let's say you slammed your hand in your car door, or you're in the back of your pickup pulling out some supplies and you fall backwards and hurt your back. So for the most part, if it's involved with your accident, you're going to have coverage for that. And it can be up to $10,000 based off of the limit that you choose. So you could use that to help pay for those medical expenses if you had to go to the doctor or the hospital. You could use it, apply it towards your medical insurance deductible. You could also apply it towards, it would provide coverage for lost wages. So if you had to miss work due to that particular injury, up to the policy limits. And then another really great feature of it is it actually doubles as a death indemnity. So in the event that you or somebody in your vehicle were killed in an auto accident, which happens very frequently, then that would kick in and it would provide up to $10,000 coverage there, depending on the limit that you choose for the death indemnity. Okay. The next part of your policy is uninsured, underinsured motorist. You currently have your limit set at $30,000 per person for bodily injury, $60,000 per accident, and $25,000 in property damage. So what uninsured, underinsured motorist is the same scenario that we just painted a few minutes ago. In the event that someone hits you, and let's say they did not have insurance. If they did not have insurance, this would kick in and would pay up to those limits. Or let's say they did not have enough insurance. So if they had the same limits that you have here, which are $30,000 per person bodily injury, $60,000 per accident, and then $25,000 property damage, which would be the state minimum liability. If they had those limits, and let's say you sustained $50,000 in bodily injury and medical payments, basically, then their insurance would cap out at their level of $30,000, and then your underinsured motorist would kick in and pay that deficit up to the policy limits. I would, at a minimum, strongly encourage you to at least increase this over here to the same limits that you have on the liability part. Now, you can't have more than what you have on liability, but you can at least have on the same. And then you have uninsured, underinsured motorist property damage of $25,000. That's okay as long as you do not have a vehicle that is valued over $25,000. If you do have one that's valued over $25,000, I would strongly encourage you to increase that to make sure that it's adequate to ensure the value of your vehicles. The importance of that is in the event that event did occur, having an uninsured motorist will not impact your loss experience, won't impact your rating. There's an industry standard of a $250 deductible, so you wouldn't have any repercussions of that because it wasn't your fault. If you did not have that particular coverage, then if that person did not have insurance, in order to get the repairs made on your vehicle, you would have to file it under collision, which we'll talk about that next, but that could impact your ratings and so forth. So it's a very important segment of your policy. If you think it would be wise to consider higher limits, just let me know, and then we will, I'll take note of it, and then I'll go back and crunch the numbers, and then when we meet again, I'll present them to you, and then we can go from there. Sound good? Okay, great. Okay, so the next part, so on vehicle one, the 2017 Nissan, you show that you have $1,000 deductibles for both collision and other than collision, and we also call that comprehensive. So collision would be, per the definition of the policy, is the colliding or upset with an object. So collision could be not just hitting a car, but it could be like my wife. She backed into our house one time. You hit a road cone. Any type of collision is a collision claim. I've had a customer before, had a grill in the back of his truck, and he didn't have it strapped down properly. He hit his brakes, grill slammed down, went into his back window, dented the bed of his pickup, and so forth. Well, he got hit with a collision claim. He was upset because he's like, I didn't have a wreck, but his grill collided with him. His negligence for not strapping it down. So that would be collision. Other than collision is basically everything else. So your vehicle policy is pretty much a comprehensive policy, meaning almost everything's covered, any type of direct physical loss unless it's excluded. So other than collision or comprehensive claims do not go against your loss experience, your loss history. And you currently have your deductible set actually for both vehicles at $1,000 on each limit. So what that means is you're basically saying, hey, I'm going to assume the risk of the first $1,000. And then after 1,000, insurance company will step in and pay for the remaining amount. The loss settlement on your vehicle policy is actual cash value. So what that means is the company would pay the average market value of your vehicle at the time of loss. So you know that vehicles depreciate. They're not worth the same today as they were a year ago, and so forth if you would have bought it new. So it will be the actual value at the time of loss. One more piece on this auto policy is you actually have auto death indemnity. What the auto death indemnity is anyone who's in your vehicle, as a named operator, dependent, and so forth. If you were killed in an auto accident, it would pay up to $5,000 in the event of a death of an auto accident. If you're protected behind a seatbelt or an airbag, basically it would double up to $10,000. So between this and the personal injury protection, that could be up to $20,000. And some families don't have life insurance for some reason. And there's several times to where this has been the only type of death benefit families have had. So it's a very good benefit. So we want to make sure that we have all of your family listed on here. I currently show that we just have you and your spouse listed on the policy. So we need to make sure that we add all your children to this so they are covered as well. Any questions? Okay, great. Moving down, the next part is we will cover your homeowners policy. So this is your declarations page for your homeowners. Here's your policy effective dates. Can you verify your address for me? Okay, verify the construction of your home. Show it as brick veneer. Verify the roof age. We definitely want to make sure the roof year is correct. That actually has a pretty major impact on rates. So if you've replaced your roof since 2017, we definitely need to get that updated. And we show that we have a composition shingle roof. Is that correct? Okay. Okay, so going into the coverages, initially, your policy is I have it blacked out up here, but your policy is an Homeowners A4. So what that means is basically just the policy type, and it has a certain amount of coverages that come with it. So this is the covered perils. Perils is defined as a cause of loss with the Homeowners A4 policy. So this column right here is our Homeowners A4. So basically you're eligible for all of these covered perils on the left side here: fire and lightning, windstorm, hurricane or hail, aircraft, vehicles, riot, civil commotion, smoke, explosion, vandalism, malicious mischief, theft, freezing of pipes, AC systems, sudden accidental discharge, leakage, overflow of pipes, falling of trees, including trimming and topping, objects falling due to the weight of ice and snow, collapse of the building, and glass breakage. So in the event one of these perils, cause of loss, occurs and it causes physical damage to your home, then it would be covered. If it's not listed here and something happens to your house, it would not be covered. Example, if you spill a glass of red wine in your carpet, I don't see a covered peril of spilling of red wine. So in that example, it would not be covered. Okay. With your particular policy, this is the loss settlement, which is down here on the bottom. So we show that your house is replacement cost on your dwelling and replacement cost on your roof. So in the event that there was a loss, we are going to pay to get that home either replaced or repaired at today's cost with no depreciation. Same loss settlement on your roof of replacement cost. As you can see here, there are other policy types that have different loss settlements. Actual cash value, meaning it would depreciate down like your vehicle. Most people don't want that. Most people prefer to have a replacement policy because it's kind of like the Cadillac or the ribeye steak of insurance, I guess you can say. But it's the most comprehensive coverage that's going to definitely take care of you and get you back to where you were prior to the loss. In the event that you don't, we do have other options, have different price points and so forth. And if that's an interest area you have, then we can go over those as well. Coverage on your house, you have coverage A, which is your dwelling. So currently we have your house insured at $285,400. So that would be covered for the dwelling, roof, anything attached to your structure. You have a 10% automatic extension of coverage to other structures. Other structures is basically some type of outer structure, outbuilding, immediate perimeter fence, basically a structure that's within direct clear side of the house, only separated by like a fence row. And, it's got to be right there. If you live on 40 acres and there's a barn or a shop at the back 40, it's not going to be covered for that. It has to be in your immediate area. It's also not going to cover any type of commercial usage as well. So we're in Texas, we have a lot of agriculture. So if you have a barn out here that stores your tractor and you have cows, that is not personal usage anymore. Farm, we try to make a profit. Most of us don't, but we try to make a profit. So being that it's used for business, that is technically commercial usage. So that automatic extension of coverage does not apply. We would actually have to set you up on a different type of policy and physically schedule that barn or that shop to make sure it's covered. But as long as it's personal usage, direct clear side of your house for the most part, then included in your premium for no additional charge, you would have up to 10% of the dwelling. So $28,540 for other structures. Coverage B is personal property. Personal property limits basically your contents of your house, any items that are used to service the house that are on your premises. Your limits are currently set at $171,240. You can have more than this. We just can't exceed the value of the home. You also have an additional 10% extension of coverage of your personal property for personal property off premises. So probably the most common accidents or claims we see on that is if you were to be traveling, stay in a hotel room, and someone broke into your car, stole your laptop, any type of personal items you had. Well, big misconception. A lot of people think that that's actually filed on your auto policy, which is incorrect. You don't have contents coverage on auto policy. That's actually filed on your homeowners due to personal property off premises. So it's a very good coverage that you have associated with your policy with no additional charge. You have an additional 10% of coverage A for loss of use. So loss of use coverage, best example, if you have to temporarily reside outside of your home while repairs are being made. So if you had a covered claim, if your wife is like mine, she doesn't cook very well, she's prone to kitchen fires. So in the event that there was a kitchen fire and you guys had to go stay in a hotel for a few weeks, couple months, whatever, while the repairs are being made, you would have up to $28,540 for that additional cost of living. We do have a limited identity theft coverage. Basically, if you're the victim of identity theft, we've got up to $5,000 there for recovery and trying to assist. However, we're not an identity theft monitoring or protection company. So if that is a big concern of yours, I strongly recommend you pursue some other type of identity theft protection. You do have two different deductibles associated with your homeowners. Deductible 1 is towards the perils of windstorm, hurricane, and hail. So most commonly your roof, obviously wind can blow down a barn and so forth, but it is for those particular perils. And then deductible 2 is all other perils, which is basically everything else that we just read through on this particular sheet. Currently, your deductibles are set at 1%, which is the lowest that it can be, and it's 1% of the dwelling amount. You can, for the most part, increase these in 0.5% increments if you wanted to save a little money on premium and assume more risk yourself, and that could be increased up to 5%. And this is your current annual premium on your policy. So do you have any questions on the home? Okay. Commercial fire and liability. Do you guys have any type of businesses, any other structures where you're operating out of for business purposes, anything outside of your just personal home? No? Okay, great. Next section is to be special property floater. So what this is basically what we'd call a personal articles floater. It kind of falls under the inland marine part of insurance. Anything that's movable, boats, farm equipment, jewelry, furs, etc. So the reason why this is very important, one, when it comes to like boats, farm equipment, lawnmowers, a big common question I get is, hey, is my lawnmower covered on my homeowner's policy? I mean, yes, technically it is. It's as long as it's used to service your home, and it's on your premises, that would be part of your personal property coverage. However, it would be subject to the covered perils of your homeowner's policy, and your homeowner's deductible would apply. So the first time your mom calls and says, hey, can you come on my yard? You load that lawnmower up in the back of your truck and or in the trailer, and you're going down the road. It's not covered now. If it were to like fall off the trailer or you were to be in an auto accident, collision is not a covered peril on your homeowner's policy. So actually the best way to insure farm equipment, boats, things like that, individual items that are movable, ATVs, side by sides, etc., would be on what we call an inland marine policy. Inland marine policies are all risk. Basically, they're insured against any and all direct physical loss, other than a handful of exclusions, which are typically very common sense, fraudulent, intentional damage, mechanical breakdown, normal wear and tear, some things of that nature. We could look at those. But basically, if you have an item that's of value and it's something like that, I would strongly encourage you to look at an inland marine policy, articles floater, whatnot, to properly insure that particular item. But as it pertains to your homeowners, when it comes to jewelry, you do have some limitations on your homeowners as well. So even though we have this personal coverage here, personal property coverage, when it comes to like jewelry, watches, furs, fine arts, in terms of like theft, it's just too easy for fraud. You could say someone broke in your house and stole your $1 million wedding ring, and we're like, really? Prove it. And you have no proof of it. So it's just too easy for fraud. So they do put certain limitations on your policy. You can put an endorsement on your policy to increase your coverage on jewelry, watches, furs, fine arts, things of that nature, up to like $5,000. But it's still subject to the covered perils of your homeowners and your homeowner's deductible. So actually the best way to insure your jewelry would be through a personal articles floater. You could get an appraisal on that ring, which is proof that you have it. It would be broken down into this is a 10 carat princess cut XYZ ring. Shows the value is $5,000. So we then would write a stated value policy, and in the event of any type of direct physical loss, even mysterious disappearance, then it would be covered. It'd pay the stated amount of the policy with no deductible. So that's the best way to insure jewelry. Okay, so if you have anything like that you'd like for me to look at, we can take those numbers down. I'll go back and quote it. And if you want to move forward with it, we'd probably just need to get some type of appraisal. Hospitalization, we can sell health insurance here through Blue Cross Blue Shield. If you can definitely get it through your employer, I strongly encourage that. And depending on your financial status, you may be able to get health insurance through the Affordable Care Act, healthcare.gov. I could direct you to that site. But if you don't think you'd be eligible for any type of subsidy, then we could schedule a separate time to sit down and go through health insurance. I could show you your options on that. Disability income is something that's very important for every one of us to look into in the event of some type of accident. So insuring your income is very important. So something you'd like to schedule another appointment with, I'd be happy to do so. And we can go into depth on that and try to figure out what you need. The next part we're going to talk about is your family. And with that, I just want to see what type of estate planning have you and your spouse done at this time. And when I mean estate planning, do you guys have a will? Have you created a will, a living will? Final will and testament, have you done that? You guys have some kiddos. Have y'all ever thought about guardianship papers? In the event that y'all went out on date night, for example, and were involved in an auto accident, something like that, and now your children just lost their mom and dad. Have you ever thought about, man, who would raise our kids if something like that happened? A lot of times when I ask that question, the husband and wife will both speak at the same time, and they'll say, oh, my mom. And then they look at each other and start almost like arguing, are you crazy, so forth and so on. And kind of the point of that is, if we don't have those conversations and get those particular things lined out, then we leave it to either the court system or our families to try to figure that out. And man, if your kiddos were to lose their mom and dad, they're going to need all the support they can get. They definitely don't want to be in the middle of some type of custody dispute or court battle or whatnot, especially when everybody's grieving. I mean, we just can't imagine, but that's something that can happen any day. We all know that, but it's something that's neglected as well. I don't know why. As humans, it's the only thing that's certain in life is that we're going to pass away. Um, but it's the one thing we don't like to talk about. So I'm not an attorney, so I can't write a lot of this for you, but I am, somewhat knowledgeable in a lot of these areas, and I can definitely refer you to an attorney. But I strongly recommend that you getting with an attorney and creating a will. Power of attorneys are another one as well. If you're incapacitated, you need someone to make those decisions for you. Medical power of attorneys, who would pull the plug, basically make those medical decisions for you. You may think your spouse, but your spouse may not want that responsibility. He or she may not want to be the one who made the decision and have to live with that, the rest of their life. So those are things that you owe it to yourself and to your family to take care of. If not, you're leaving it to someone else to take care of. And who wants that burden? Nobody does. So you have a lot of power in doing that now. Especially if like I have a split family. I had a prior marriage prior to my current marriage, and I actually have 2 children from my former marriage. Texas is a community property state. So in the event that if I were to pass away and I did not have any estate planning done or whatnot, well, it's 50-50, with it being a community property state. So basically my wife and children we have together, they're getting a 50% portion or whatnot, and then it's split with my other children from my other marriage, and it's not fair. So there's just a lot of things to look at. Also, if you have children that are getting to the age of 18, or if they are 18 and are away in college, you want to make sure that you get medical power of attorneys on them too, because they could be involved in an accident while they're out of college, and they're not going to be able to release any information to them because they're adults now. So just a lot of areas that we don't think about, that a short visit with an attorney, a couple $100, and you could have a nice will and take care of all these things all at once. But I'm gonna go through a couple things with you. Here's some advantages of a well-planned estate. So property is distributed according to the decedent's wishes, so the way you want it to be. Tax savings. So properly planning for your death and preparing your estate, and whatever tax laws are enforced that you're passing, if you properly plan, there can be some tax avoidance and so forth based off of how you restructure different things that you own. Appropriate ownership of assets, disability and last illness preparedness, liquidity of assets, personal peace of mind, just knowing it's taken care of. Care for your family, which is huge. We all love our children. We want to make sure that they're okay. And control of assets into future. Meet charitable goals. Maybe you have a church or something that you're passionate about that you want to leave money to. If you don't put all that stuff in writing, it's not going to happen. Some people think I'll just leave things to my kids, but there are issues with gifting to minors. Minors can't legally own or control assets. Also, if they are 18 or a young age, early 20s, they may not be ready to control assets. I personally have like 3 different LLCs and different business interests, and have, rental properties and a variety of different things going on. But my kids don't know what they're doing tomorrow, more or less trying to manage a company. So leaving them real structures and real property may not be the best way. So doing some estate planning, having someone lined up to liquidate everything, leave them funds and so forth may be a better option. And then leave them provide them a stream of income versus some lump sum payment, so they don't have the nicest car in high school. Some estate planning impediments. Failure to plan. These are some common reasons failure to plan. The estate owner doesn't execute a will, which means you die intestate, which is dying without a will. Reasons a lot of people not having a will, primarily not taking the time to think about who gets what. And then also thinking that, it'll be okay, I'll just go to my kids. Basically what you're saying is it's okay, the state's succession plan will be sufficient. So if you do not have a will, you die intestate. So all of your assets, a sheet to the state, and then the state determines who gets what, which it's better than nothing, but in most cases it's not what we want as adults, especially if we have children and people we care about. What happens without a will? We just said the state succession laws determine which property goes where. If no heirs to the property, like I said, then it sheets to the state, go to the state unclaimed department. Cannot leave to charity, cannot choose personal representation, so forth and so on. You may already have a plan, but if it's outdated, the thing is they need to be updated. Birth or death of a family member could change your current plan. Tax law changes, other legal changes, new assets, digital assets. One thing that a lot of people don't realize is that Digital assets do not have beneficiaries. So if you got money left in PayPal or DraftKings or Venmo, all these other types of things, a lot of people don't realize that if they're in there when you pass, currently they're gone. So don't leave money sitting in those accounts. But that's the whole point of talking with an estate planner or an attorney or so forth, because we're not all supposed to know everything. And that's why we have advisors in our life, whether it be doctors, attorneys, insurance agents, and so forth. So we can all specialize and contribute to society. So I strongly encourage you to take that next step. Common issues that are overlooked: simultaneous death, husband and wife, like I said, guardianship already, tax appointment, expenses and time, improper tax planning, improper ownership of assets, like we said, digital assets, failure to plan for disability or illness, failure to consider inflation, time value of money is huge, lack of liquidity, spousal elective shares due to poorly drafted will, so forth and so on. So anyway, surely I've triggered something in your mind today that's making you think, man, I may not have been prepared as I thought that I was. I know it's not fun to talk about, but I strongly encourage you to take that next step, and I can definitely give you some recommendations on some individuals that I've used myself. But along those same lines, who handles your family's life insurance program? So not only passing away and not being properly prepared when it comes to a will or a trust or guardianship papers and so forth, there's also a financial burden when it comes to passing away. So in a nutshell, if your family depends on you for financial support and they depend on your income, and in the event that that income was removed from their household, would it cause a financial burden? Would it cause difficulties and challenges for your family? Would they have to make life changes? Would they have to make alterations? And if that answer is yes, and if there would be any type of financial impact, then you have a need for life insurance. Most of us do, even when we're really wealthy. We still have a need for life insurance. We just enter different stages of life and different scenarios and estate tax planning and a variety of different things. But more importantly, primarily, if someone depends on you financially for support, then we have a need for life insurance. So what I'd like to do with you now is just go through a quick needs analysis. And this is a very basic needs analysis. We can go into depth and kind of get real in the weeds and figure Social Security or whatnot, but it's very confusing. But this is a very basic needs analysis that most of us can relate to. So just ask a few questions. So if you were to pass away today, what do you think would be the first expense your wife or your next of kin, whoever is taking care of your business, basically, what is the first expense that they're going to encounter? A funeral. So they've got to do some type of final disposition, whether it's a funeral or cremation, whatever it may be. So there's going to be something that's got to take place, and somebody's got to pay for that. So have you been a part of any type of funeral planning here recently in the last couple of years? Okay. If you were, how much, can you recall how much that particular funeral costs? Or do you know somebody who, knew how much it cost or whatnot? Did they have the funds available? Things of that nature. Okay. Well, most commonly, average cost for a funeral in our area is going to be 10 to 15,000. I've seen prices all over the map. I personally went to mortuary school several years ago, and I've seen funerals up to $30,000, $40,000. I mean, it's an emotional time. Sometimes people just want the best for mama. I mean, it just depends. It's hard. It's hard to spit out a specific number, but 10 to 15,000 is very common because that's just going to be an immediate cost right off the bat. So in asking that, if something were to happen to you, would you want to leave funds for your spouse or whomever to be able to take care of those final expenses so they don't have any type of burden on them? Okay, great. What else do you think could be associated with your death? What other type of cost can you think of right now that could be associated with your death? Typically, there's probably going to be some type of medical expenses associated. Someone's going to call 911, ambulance ride, hospital, something. Usually there's going to be some type of medical expenses that could be billed to your estate if someone files claim on your estate, or your wife could be responsible for paying for, or whomever. So another common area that's overlooked is taxes and income taxes. Just because you pass away doesn't mean Uncle Sam doesn't want his last bit of money from you. So your spouse is still going to be filing taxes at the end of the year and so forth. So with that said, it's not only the funeral cost, but there's other areas that we're just not going to think about. So when it comes to permanent needs, final expenses, I usually encourage people to have at a minimum 25 to 50,000. That's going to take care of most things immediately upon your passing. So does that make sense to you? Do you agree with that? Would that be something you'd want to plan for? Okay, great. So we're just going to plug in 50,000 in this particular area. Okay, the next part of the needs analysis is our mortgage or rent replacement. So most customers, in the event that they passed away, they would want to pay off their mortgage for their surviving spouse and family. Because in the event that something were to happen to them, they just lost a parent or a father or a mother or whatever. We don't want them to have to relocate and change homes and all those types of things. So if something were to happen to you, would it be important to you to leave fundings to pay off your mortgage? Or if you rent, it's still your home. Home is where you make it. And so, I mean, would you want your family to stay in your same home, or that they consider home? And if so, would you want to take care of that rent for an extended period of time? And if so, we just need to allocate funds for that. So about what would it cost to pay off your mortgage today, and or how many years of rent would you want to pay up? Next category is going to be debts, liabilities. So most people want to just wipe the slate clean. So if you were to calculate auto debts on auto loans, personal unsecured loans, credit cards, student loans, whatever, any money that's owed to anyone, basically, that your spouse or whomever's on the loan with you, or anything that could be filed on your estate, most people would want to wipe the slate clean. That way they just lost your income and you're not leaving any type of financial burden. So if that's something you feel would be important that you'd want to accomplish, we just need to add that up real quick. Okay, 100,000. The next category is legacy fund, children's education. It just kind of depends. When it comes to college education, my sister and I are kind of 50-50. We grew up in the same house, same struggles and so forth. I joined the Army to pay for my college, got it taken care of. She resorted to student loans. I'm very passionate about leaving money for my kids' college education. She's kind of more snobby about it and says, nobody helped me. So it's kind of to each his own. Personally, I feel very passionate about leaving money for my kids' college education. I just kind of envision, if I'm not here to see them walk the stage, that, I just kind of have this vision, my daughter walking, getting her diploma, looking up at the clouds. Hopefully that's where I'm at in heaven. And basically saying, thank you, Dad. And then having that reminder on her wall each and every day of her life, knowing that Dad did that for her. So it's very important to me to provide those funds. And if she doesn't elect to go to college, well, I've got my money going into a trust. I've done some estate planning of my own, and then she can spend it elsewhere based off of the rules and guidelines that I've placed to the trust. But it gives me peace. That's how much I care about my family and my kiddos. I don't want to press my values on you. If it's not important to you, that's okay. Some people look at it as just like a legacy fund. I don't know what they're going to do, but, I just want to leave them X amount of dollars, at least to get them going. Maybe it helps them buy their first house, whatever it may be. So it's up to you. Average cost of tuition fees, books, room and board in the state of Texas, not considering private schools, but you're looking, 20, 30 grand a year. Tuition fees, books, room and board. My previous manager, I know his daughter went to Tarleton University, and I remember him saying that he was on a payment plan of like $26,000 a year. I mean, it was crazy. So pretty much just do the math, however many kids you have, and we'll go from there, and we'll do the math. Okay, so you got 3 kids, I think 80,000 a piece. Okay, good. Okay, the next category is readjustment income. So we're going to wipe up, we're going to take care of the funeral expenses, we're going to pay for your mortgage, which I forgot to put in there. We're going to pay for your mortgage, we're going to take care of all your debts, leave kids for college education. And then the last category here is typically the most important and the most overlooked. So basically, in the event you and your wife or spouse, you both work and or provide services to your household, that helps you or allows you to maintain your current standard of living. In the event that one of you are removed, now that standard of living is in jeopardy. So the question is how long do you want your wife and kids, or husband and kids, or children, or whomever, to be able to maintain the same standard of living before they have to start making major changes? And that's a hard question to answer. It's very hard to answer. I've seen it all over the map. I've seen some knuckleheads say, I don't know, 6 months, and the wife punches them in the gut. I've seen some people say 5 years. I've seen some say 10. I actually just wrote a policy on a husband last week. And when I wrote his policy initially 3 years ago, he thought 5 years was adequate. And then now he's came back after a routine review and he's thought about it more. And he said, the more I think about this, I want to take care of my wife forever. I love her. I know she'll get remarried or something at some point, but that's what I want. And I said, man, I can't take that from you. It's your policy. If that's what you want, then let's shoot. So we wrote up a pretty hefty policy for several $1 million. And and it's catered to him. So the question is how long would you want your spouse and children to be able to maintain the same standard of living? Personally, when I took out my policy, um, I ended up selecting 5 years as the way I chose mine. I thought, I'd been through a divorce before, not lost a spouse due to death, but I'd been through a divorce and kind of went through that grieving process and so forth. And, by year 5, I was kind of back rolling again. So that was my justification to it. So, if you want to say 5 years, 10 years, whatever it may be, we basically just want to take your annual income and multiply it times that amount. And that's how we can come up with that readjustment period. Okay, so we'll say 100,000 times 5. Do you currently own any life insurance? Personally own life insurance? No? Okay. And do you currently have any employer-owned coverage? Mainly, meaning do you have a benefit through work and so forth? No? Okay, great. Okay, so based off the things that you said you would want to accomplish in the event that you passed away, we're coming up with a need of $1,140,000. So basically, that's your deductible on death. And that's a big number, and that's something you need to take care of. You've got your home and auto taken care of currently. We've reviewed it. And those are just things. Our families are most important, and it definitely has a larger insurable number than anything we've covered today. So now that we know how much you need, now we can kind of discuss your different options. So in a nutshell, there's so many different life insurance policies that are out there. The worst thing you can do is get on the internet. You will be confused. It'd be like you trying to become a financial advisor today and learn investing and stock market and so forth. I mean, it's crazy. But to keep it simple, there's basically 2 different types of life insurance. There's temporary and then there's permanent. And the products that we offer that go with those 2 products are temporary, meaning term insurance, permanent insurance being whole life insurance. So term does exactly what it says it does. It lasts for a specific term. So let's say 20 years. What that means is if you had $1.1 million in life insurance, then your cost of insurance, your premium, will be locked in for a 20-year period. After that period's up, you can kind of think of the policy as going away. They would continue to offer it to you, but your price would start increasing on you. Term does not build any type of wealth. There's no cash value, internal growth. There's no other type of tangible benefit within the policy other than just passing away. It's a death benefit only. Still a great product, but it does not build any wealth. Term is kind of like renting a house. It takes care of the need. It's usually cheaper to rent a house versus own a house. And you could live there for 20 years, like you could keep the policy for 20 years, but once that fixed period expires, then it goes away. Just like you move out of your rent house, you get nothing back. Landlord says thank you, and then he moves the next one in. So that's kind of like term. It's still a great product, just understanding how it is. Term is going to be the least expensive as far as paying a monthly premium, but term is going to be the most expensive over time because you get nothing back. It's strictly a pay-in. You're renting that policy basically, so you'll get no return of premium, things of that nature. Whole life is permanent insurance. It lasts your whole life. It's kind of named appropriately. Whole life is kind of like renting or owning a house. It's usually costs you a little bit more to own a house. You're responsible for all your upkeep and maintenance. You have to pay property taxes, pay insurance. I mean, a variety of different things. But the good thing about a house is that it appreciates in value, and then you get to reduce the balance. If you have to take out a loan, you gradually get that house paid for. And then as long as you pay your bills and you keep it the full term, you can live there the rest of your life. And that's basically like a whole life policy. Whole life policy, just like owning a house, you're gonna pay a little bit more monthly for it. But a whole life policy, it never goes away. It lasts your whole life. And whole life policy does build wealth. It builds cash value within the policy. Or if you think of it as a home, it builds equity into the home. I can do a cash out refinance on my homeowners policy. And I can do pretty much the same thing on my whole life policy, and I can borrow money from myself. And then I can pay myself back. There's actually a lot of different strategies you can do financially with the cash value in your whole life policy. I won't go into that today, but nonetheless, it's a very good product. It's a very good option. Money that's in life insurance and annuities, the cash value there can't be accessed by lawsuits, liens, or judgments. So that is another very good benefit. We have a product that's called a 20-pay whole life, which just means you pay on it for 20 years, then it's paid in full, and then you have it forever. My personal policy I took out when I was 27. It'll be paid in full when I'm 47. Over 20 years, I would have paid in $180,000 by the time it's done. I'm halfway through it now. But my cash value at that 20-year mark is going to be roughly 190,000, somewhere around there. So I should recoup back, depending on dividend growth, all of my premium basis, plus a little bit of a gain, and that'll put me at 47 years old. I'm done paying for it, but it still continues to grow. You fast forward to age 65, based off of my in-force illustration now, I should have somewhere between $390,000 and $400,000 in cash value. So to me, it's kind of like an investment with a death benefit. That's the way I think about it. I try to think about not my premiums not being premiums. I tell myself they're contributions, because I can actually log in and see that cash value growing and so forth. So anyway, they're both very good. They both have a time and place for each product. But now you have a decent understanding of it. I'm going to go and do some quoting for you, and I'm going to show you 3 different product options. The first option I'm going to show you is going to be 100% whole life. I'll go and tell you that 1.1 million in all whole life, and I'm going to quote it on the 20 pay just like I have, because I feel it's probably one of the more advantageous policies. You can pay on it till age 100, but it's hard to make payments when you're in retirement years. So now we can make more money, and it's easier to pay a higher premium. So I'm going to quote it on a 20 pay whole life, which means you only pay on it for 20 years and then you're done. You have it forever. But 1.1 million is going to be hefty. It's going to be a big premium. Some people can't afford it. A lot of people can't. And if you can, that's great. But if not, nonetheless, I just want you to understand the way the policy works and see the value in that policy. And then from there, I will show you a quote or illustration with it all in term, which will definitely be affordable. Very seldom do I have somebody who cannot afford a term policy. Even $1 million is very affordable. So worst case, you definitely be in the boat for that. And then the third option I'm going to show you is kind of a combination of each, a little bit whole life and the rest of it in term. Okay, first option I'm going to show you, as I mentioned, was all 1,140,000 and a whole life policy that's paid in force within 20 years. So in this illustration, you can see here, this is the guaranteed benefits. Okay, so no matter what, the policy will at least perform at this particular level. So right now you're age 37, so you can see, and then you can see after the age of 38. You're going to be paying $2,317 a year, or a month, excuse me. And then after the second policy year, your cash value will start to grow. So you can see here that you're going to pay $2,317 monthly for the first 20 years. Okay, after this 20-year mark, then the policy is paying full. No more premiums are due. This column here is your cash values. This is your guaranteed cash value section. So at each particular point, your cash value will be no less than this particular number. This is your money. You have access to your money. You can use it for, leave it alone, and it's going to sit there and grow, and it's going to get tax deferred growth. You're not going to get 1099 each year. Even once it gets into gain status, it's just going to keep growing. You can borrow from it, a variety of different things, but just know that this is your money. It's not like paying term or paying rent on a house. You're actually seeing your money come back to you internally. This particular column is your death benefit. So the death benefit will never be any less than how we start the policy. And then this column here is reduced paid up. So let's say at age 47, I don't know, you lose your job, you get disabled, something, and money's just tight, and you just can't pay this premium anymore, but you don't want to lose your coverage. So at that particular age, you'd have no less than $202,339 in cash value. So that would actually pay up $571,140. So basically what we can do is we can reduce this death benefit down to this amount. And basically this amount of cash value pays up that much life insurance. So now the policy is done. So no more premiums are due. You have that little over $500,000 in coverage, and the policy is paid in full. It will continue to still grow dividends and things after that point. But that's a non-forfeiture option, a way of still salvaging your coverage and not losing everything that you've done. But after 20 years, policy's paid in full, and as you can see, it still continues to grow. So there's going to come a time to where you may not need all this coverage anymore, and then you've got options, which is a great thing. If we come down to a couple more slides here, and it comes into non-guaranteed benefits. The only reason why it says non-guaranteed benefits is because now you see an annual dividend right here. Farm Bureau's life insurance policies are participating policies, which in a nutshell, the dividend means, you participate in company profits. The definition of a dividend with life insurance means actual return of premium. But nonetheless, the company legally cannot guarantee a dividend. They've never not had a dividend year. But right now they're projecting, say, the first dividend of being $798. If it ends up being $750, well, it's not exactly the same, and that's why it says not guaranteed. But based off of current projections, it's projected that your first dividend being $798. What that dividend does is it comes behind the scenes and it buys an additional $2,792 of life insurance. So then you see the death benefit increases. Okay. The next year you get your dividend, buys more insurance, death benefit increases, so forth and so on. The way whole life works is the cash value of the policy, this particular column here, has to equal the death benefit currently at age 120. So every time this policy gets a dividend and it buys more life insurance, the life insurance increases, so the cash value has to jump up and increase, and it has to catch it. So it's called an endowment policy, which means the internal value equals the face value of the policy at a given age, and this one is at age 120. So if we look at this example with dividends versus without, so the guaranteed when this policy is paid for, you have a little over $529,000. If we come down here and look at projections with dividends, you're projected to have almost $590,000. So you're going to have somewhere between those numbers when this policy is paid in full. After it's paid in full, it continues to grow. You fast forward to retirement years, and you've got $750,000 basically sitting there. Policies paid in full, you have a death benefit. There's just a lot of different options you can do. Now I do realize this is very expensive, so I just wanted to make sure that you understand the policy. Okay. So now I'm going to show you the coverage, the same volume amount, and I'm going to show it to you in term coverage. So this one I'm quoting. We have 3 different term options, a 10, a 20, and a 30. Just going to shoot the one in the middle here, and show you what that value is going to be as far as the premium basis goes. Yeah, so the premium for this, the same $1.1 million in coverage, is only $112 a month. That's a lot better than $2,300 a month. We know we can afford that. I told you in the beginning, it would definitely be within reason, and that's not bad money at all. And I'm actually quoting you on a standard average person rating. There's actually better ratings. There's a preferred and a super preferred, and man, it gets really inexpensive when it comes to that. To me, you look healthy on the outside. Your height and weight looks good. I don't see any reason from my perspective why you wouldn't qualify for a better rating. However, I don't know what's going on in your insides. I don't know your blood pressure, cholesterol, things of that nature. But just know the company always underwrites for the best possible rate. So if it turns out that you're approved for a better rating, then we just send you a refund back, and then your premiums are adjusted. But worst case scenario, we definitely need to make sure we cover at least this. It's all term. There's no cash value growth, so I don't show an illustration. Just know that you're going to have the same death benefit, okay, face amount of the policy, and you would have a locked-in premium for 20 years. And after 20 years, just think of it as it's going away, but definitely very affordable. The last option I want to show you is basically a combination of each. So this is probably what I consider like the recommended minimal design. So as long as it's at someone's budget and you can afford this, this is what I encourage people to do because it just simply makes sense. So looking at an average life expectancy, of a human or whatnot, from 0 to 25, we don't have much of a need. Mom and dad take care of us or whatnot. But from 25 to 65, saying, approximately retirement years, this is usually our most expensive time to die. So, we're buying houses, cars, boats, taking out student loans, paying for weddings. I've paid for 2. Children, college, land, business. You name it. This is the meat of our life. If you've ever read the book, The Dash, or heard the quote, The Dash, like this is the primary part of The Dash. And this is usually the most catastrophic or the most expensive time to pass away. I have 5 children at home. I have a wife. I'm smack dab right in the middle of this. So if I'm gone now, it's going to, be bad for a lot of people. But technically these needs are temporary. The goal is by the time I hit retirement, I've paid off my house, all of my, my toys, anything that I own. Hopefully I'm debt free and everything's paid for. I've kicked my kids out of the house. If I've outlived them, I paid for college or done whatever. And the goal is by the time we hit retirement years, all that stuff is done. And now we can, now retire and live off a reduced income, because we don't have as many expenses. So if we really think about it, most of these needs in this particular meat of our life are temporary. So if you think temporary needs, think temporary insurance. But we do have needs that exist from birth to whenever we pass away. If we don't die before 65, we know it's coming. I mean, there's no avoiding it. It's the only certainty in life. So with that said, if you have permanent needs that never go away, and we know 100% it's going to occur, then we need to take care of that. The cost of waiting can be huge. We may not be eligible down the road medically to take out coverage or so forth. Or not to mention, as we get older, it gets more expensive. So if you can afford it, I strongly encourage people to take out, if we look at your needs analysis that we discussed earlier, then to take out, roughly that $50,000 in permanent whole life insurance. Okay. We set it up. So if you're like me right here, we set it up to where it's going to be paid in full in 20 years. And then what I can then do is attach a temporary policy to it to cover your temporary needs. So now we've got our permanent needs taken care of. That policy is going to be paid for while I'm working and generating income. And then I'm going to attach a temporary policy to it to cover the bulk of my need, the bulk of how much coverage that I need for my family. By the time I hit retirement years, this policy falls off because I no longer need it. And then this policy is now paid in full, and then I have it for the rest of my life, and no premiums are ever due again. It's going to continue to grow cash value, continue to grow wealth. I have access to that money and so forth. So it gives me options. And one great thing, especially since I deal with elderly people a lot too, the number one thing I hear from older people is, I wish I would have done this when I was younger. But man, when you're younger, you're thinking about living, not thinking about dying. And that's why these decisions sometimes can be challenging, even though we know we need to do it. So I strongly encourage people to do this design at a minimum. And then if you just have a good understanding of how the product works, as well as the financial ability, outside of that 50,000, you just understand how the policy works. So then you can increase and do more whole life, etc., as you have the funds available. But at a minimum, I recommend this because you never will pass on a burden to your children. Even if you live to 90 years old, you pass away, your children have the funds to take care of those final expenses. They're not having to pass around GoFundMe pages, pass the hat at church. I mean, it's just, my heart goes out to those families that are they're having to resort to that, especially when they have young children at home, and it's just, it's terrible. So this is what I encourage you to do at a minimum, and I'll show you what that looks like as well. Okay, so if we do that recommended route, once again, if we put our 50,000 in permanent needs, which we already discussed on our life insurance needs analysis, we put 50,000 in whole life policies paid in full in 20 years, and then we attach a temporary policy, a 20-year term rider, to that particular policy. It's going to fall off in 20 years, which is going to be basically retirement age. This is going to take care of the bulk of your need. One thing I failed to mention, but I'm also going to put a child term rider on there. It's just a blanket $20,000 coverage. It'll provide up to $20,000 per kid in your house. If you have a new child, as soon as they turn 15 days old, they're automatically covered, which is huge if they were to be born with some type of disability or something like that, to where they wouldn't otherwise be eligible. It's not much cost at all, but to have everybody in your house protected and to have you with this minimal recommended plan, then you're looking at $224.05 a month. So you basically have three options. So we have it all in whole life, which, man, if you can afford it, it would be great. Roughly, what was it, $2,300 a month? We can do it all in term, which we know is affordable. Most people can afford that, of the same volume of 1.4 million, or 1.1 million, excuse me, for $112 a month. Or we've kind of got one in little middle of the road. We've got the recommended, the 50,000 permanent needs are going to definitely take care of all of your needs and life stages. So you have 50,000 permanent insurance and the 1.1 in term, and you're looking at $224.05 a month. So as of now, which one of those do you like the best? Okay, guys, thank you for watching this today. I hope it was beneficial to you. I tried to do it as realistic as possible in terms of how I would actually go through this and give stories and give examples with customers and so forth, and especially during the life insurance part, and giving examples with that, the way I design policies and so forth. So sometimes it's a little lengthy, sometimes I'm quicker than others, but I really try to make sure that I hone in on the value of things. Telling stories I've learned to be very effective when selling any type of products, especially when you can relate to them emotionally and so forth. So I hope this is valuable to you. Typically at that last segment there, when I ask which one of these policy designs do you like the best, that's kind of my first attempt at a budget. Pretty commonly I hear customers go, man, I really like the whole life, but I can't afford $2,300 a month. Usually my next statement is, hey, that's great, I understand. How much can you afford? And I'll just design this thing to where you get as much whole life as possible while still taking care of the rest of your term coverage and your need, but it was staying in your design budget. So if you just kind of tell me what your budget is, then I can design it accordingly. If they kind of stumble around a little bit and don't give me much, I'm like, well, so we started with the 50,000 on the mixed plan, 50,000 whole life and the rest in term. And it was $224 a month. Was that doable? Did that seem pretty good in your budget? Was that doable? And usually they'll tell me yes, or one way or another, or they may say, no, I need to go a little bit lower than that. What can we get for 150? One common thing you can do is a piece. You could say a piece. Sometimes makes them jump back a little bit, but you're trying to design policies for them and their wife. And if you've done a good enough job with the needs analysis and explaining the value of these products, then they typically want it. But basically your goal is to get an overall budget, and then you can sit there and play with it if you would like, and try to get the coverage down or the premium to wherever they can afford it. From that point, usually, because they're really held up on whole life, I usually come back and say, hey, it's not an all or nothing today. It doesn't mean you have to make the final decision today. We just need to pick a decent design that's in your budget, so we can get this underwriting process started. You guys are going to try to think about budgets and so forth. But the company needs to think about you as well. So we've got to go through underwriting. There is a process for that. It usually takes 30, 45 days, up to 60 days for these policies to issue. So, they want to make sure that you're not on your deathbed and so forth. Once this policy issues, then I know the exact rate that was offered to you. You may get a preferred rating or super preferred. And then I can actually come back and present you an issued policy. And then we can make more informed decisions at that point. If we need to make changes, increase something, decrease something, or whatnot, we have the ability to do so. This is also where I inform them of their conversion options. Let them know that, hey, once a year for the next 10 years, being it's a 20-year term rider, we can convert a minimum of $25,000 up to the whole amount to permanent whole life, a guaranteed issue regardless of medical history, health, medical conditions, and so forth. So you really sell that conversion and tell them that you're going to call them every year prior to their birthday. So, but the goal is to get a budget, get a commitment, and get this thing into underwriting. So I hope this was beneficial to you and you could take something from it. If I can be a help to anyone, feel free to give me a call at any time. Thanks, guys, and good luck. So hello, Mr.